This tweet provides a useful exercise to show why I would be surprised if the stock market doesn't trade lower over the next 12 months. In this video, I would like to break it down together, but first I want to make something very clear. This is not a prediction. I don't make those. But we have on the channel correctly followed this economic situation since November of last year when I first pointed out that interest rates could begin rising. Then I correctly pointed out at the beginning of this year that the yield curve was about to invert, signaling a recession. To which someone replied that I explained the concept better than their economics teacher at university, Professor Tony. At your service. And then, right at the first major bear market bounce of late March, early April, I put out a video aptly titled, "Think the Market Crash is Over?" in which I laid out 3 possible scenarios going forward. Turns out, scenario number 1, the big Titan, played out. And here we are. Finally, mainstream media has caught up at this point and started talking about a recession, and the Fed has all but admitted to actively causing one to try and slow down inflation. Everyone knows this at this point. That's yesterday's story. If you're getting your market news from somewhere like CNBC, oof, you're living in yesterday's world, my friend. Tomorrow's story is going to be what drives markets going forwards. And tomorrow's story could be a nasty earnings recession, something which I'm not seeing priced into markets at all at the moment. How do I know that? Because earnings estimates have not come down at all. I mean, just Google it. So what does this all mean? Especially if you're new to investing, this might sound a little bit confusing. Let's walk through it together with baby steps. So this is a price to earnings ratio, possibly the most common way to get a quick gauge of the value of a stock. Many of you will be familiar with this ratio, and if you're not, don't worry. Understanding this very, very basic ratio is going to help you easily see potential paths forward in the market. Okay, so let's pretend I have a company. Let's call it Tony's Pizza Parlor. And let's say my stock is trading for $100. So that's the P in the PE ratio. That is the price per share. And then let's say for every share of my company, I earn $10. That's the E, earnings. So what this means is if you buy my stock for $100 per share, there are $10 worth of earnings associated with that share. So the PE ratio is 10. 100 divided by 10 is 10. What this tells you is that for my company, Tony's Pizza Parlor, it'll cost you $10 to buy $1 worth of earnings. But is this really useful to know by itself? I mean, not really, right? This only becomes useful when we can compare it to other companies' PE ratios. So let's say, for example, we have Luigi's down the street. Let's say his pizzeria has a PE ratio of 20, meaning it'll cost you $20 to buy $1 worth of earnings. Aha. So on this basis, we could say buying my company's stock provides more value than buying Luigi's because you're getting more earnings per $1. But that's assuming everything between these businesses is equal, which it probably isn't. For this reason, because all businesses are different in one way or another, you can't really compare them on the PE ratio alone. This is a discussion for another day though. For now, I just want you to understand the basic components of the PE ratio and what it all means. And now I would like to take that a step further and show you a reasonable picture of how the stock market could decline further than where it is today. However, before we do that, I'd like to take a quick moment to thank today's sponsor, Masterworks. Masterworks is doing something really cool, democratizing the ability to invest in blue chip art. What do I mean by blue chip art? I mean the type of art that you see in museums. Banksy, Picasso, Warhol, Kusama, you name it. And so in the same way that I can't exactly go out and buy the entire company of Apple, I have to buy small shares of Apple, Masterworks buys entire pieces of art and then splits up the ownership of this art into small shares that you and I can purchase. And the interesting thing is, valuable artwork like this has historically outperformed many of the classic assets that you're familiar with, even in inflationary periods like the one we are currently experiencing. Of course, important disclaimer here that past performance does not indicate future results. But sadly, in the past, this great performance was only really available to the ultra wealthy because they were the ones who could afford to buy art like this. Now, that's all changed thanks to Masterworks. So if this sounds interesting to you, you can check out the link in the description down below to skip the waitlist and get access to the Masterworks platform. Thank you so much for sponsoring this video. Okay, let's return to our PE ratio. So the cool thing is we can actually look at the PE ratio for the S&P 500 itself to give us a broad understanding of the stock market. Now, right now, as I'm recording this, the price of the S&P is about 3,700, and the earnings for the last 12 months were about 192 per share. So dividing 3,700 by 192 gives us a PE ratio of about 19. Now there's a lot that we can actually analyze from this. The first thing we can learn is that so far the stock market has fallen because of something that we can call a multiple compression. In plain English, what a multiple compression means is that someone is now willing to pay less money for the same thing. The thing didn't change, but people are willing to pay less money for that thing. And usually this is because the outside environment has changed. And that's what has happened, right? Investors have been willing to pay less money for the same companies this year, even though the companies have still been earning the same amount of money so far. So the P in our ratio changed, the price changed, but the E, earnings, didn't. This, a multiple compression, generally happens because the environment is changing, because something is causing investors to become more fearful about the future. And in our case, investors have been increasingly anticipating a recession as the year has gone on. That, in a nutshell, describes this move down so far. But what about if and when the recession does actually arrive? What happens if the E begins to change as well? That's what I'm kind of thinking might be next. As it stands today, investors are forecasting the S&P to earn about $222 per share for this year and $239 per share for next year, which is an increase year over year of about 7%. So if we assume that that's correct for next year, let's maintain the same PE ratio here of 19. So doing that calculation, that's going to imply a value for the S&P at the end of 2023 of 4,541, which is a whopping 20+% higher than where we are today. I don't know about you, but this forecast seems a little bit off to me. If we are in fact going into a recession, shouldn't we be forecasting earnings to be decreasing, not increasing? And by how much? Well, in some recessions, they drop a bit, and in some, they drop a lot, with the average over the past 10 recessions being about 30%. Yikes. So let's say that played out. Let's say we had about a 30% earnings recession. We'd be then looking at 155 for earnings. Now, assuming again, no change in the multiple, that's an implied value of 2,952 for the S&P. About another 20% lower than where we are today. And like I said, that's assuming no change in the 19 for the ratio. That can easily change too. So I hope this has been illustrative of how markets can trade and then price themselves as they anticipate an economic slowdown. So they first kind of act on that P as people are willing to pay less, and then as the economic slowdown actually hits, it begins to act on the E, the earnings side of the equation, which can then basically bring the entire valuation down further once again. Both of these things together in a full-blown prolonged recession can kind of create this double whammy scenario that provides some serious headwinds for stocks. Now, I know many of you are thinking this. I know it's a question on everybody's mind. But Steve, what about the Fed pivot? Well, my friend, monetary policy works with a lag. And what I mean by that is when they raise interest rates and do things like that, this takes months for the effects to fully kind of seep in and sweep through the economy. And the chain of events that they have already set in motion will continue to sweep through the economy for months to come. If and when the Fed does decide to pivot, again, this will take months to actually seep in and then sweep through the economy. So if an earnings recession is indeed upon us and like imminent at this point, it is far too late to stop it now. But I don't think that'll stop markets from having any more face-ripping rallies anytime the whispers of a pivot, the Fed put grows louder. Especially because many people are positioned quite bearish right now. I mean, this has been the most telegraphed and obvious incoming economic slowdown I think anyone has seen. And so today, this has not been a prediction. These are just a few of my thoughts on what I think is a potential reasonable path forwards for the markets over the next 12 plus months. But there are obviously many potential paths stemming from this moment in time. Some seen, some unseen, and if the past few years have been any kind of guide, no one knows what is next. Oh, and by the way, if you're wondering, like, hey, I haven't seen you do a little market update in a little while. Yeah, well, it's because first of all, I pretty much laid out everything earlier this year. And second of all, I don't intend to be on here hyperventilating every time the market moves a little bit. I don't think that's helpful. In fact, I think it's actually probably detrimental to people more than it is helpful. Once you find the signal, you can tune out the noise. Peace.